Welcome back to the Deep Dive, the TalkTickers edition. We're here to cut through the earnings call noise and just give you those essential insights fast. Focused.
Yep.
Today, we are plunging into Smith Douglas Homes. It's their first quarter 2025 earnings call.
That's right.
We've got the results, we've listened to the commentary, and our goal really is to break it down for you, the experienced investor, figure out what actually matters here.
Absolutely. It's their opening quarter for fiscal 25 and, well, navigating this housing market right now. It's complex.
For sure.
So there's quite a bit to cover from the headline numbers to their specific strategies. Land, build times, incentives.
Okay, so let's start there, that initial snapshot. How did they actually do in Q1?
Sounds good.
Looking at the top line, Q1 2025, home closing revenue, $225 million.
Right. And what stands out there is the year-over-year comparison.
Yeah, it's a solid jump, isn't it? 19% over Q1 last year.
It is. And they posted net earnings per share of 30 cents.
Okay.
And on the margin side, home closings gross margin hit 23.8%.
Which was interesting because didn't they say that was actually better than they guided?
Exactly, yeah. Higher than their own guidance. So notable.
And orders, how do new orders look?
Net new orders,
Right.
768 homes total.
Yeah.
Which translates to a sales pace of about, 3.1 homes per community per month on average.
Okay. And the price point?
Average sales price nudged up a bit, $335,000.
Yeah.
Management said that was mostly, geographic mix, product mix shifts.
Gotcha. So different locations, different types of homes closing.
Right. Now, bringing it down to the bottom line, reported net income was $18.7 million. Pre-tax income, $19.6 million.
But those are lower year over year.
They were, yeah.
Okay.
Both lower than Q1 last year. And they also gave an adjusted net income figure, $14.7 million.
Okay. And that adjusted number, that's for comparing them to regular C-Corp.
Right, precisely. We should definitely unpack those adjustments later because it tells an interesting story about how their structure impacts the reported numbers.
Definitely. Okay, let's dig deeper then, beyond just the numbers. Execution. Management seemed pretty happy with it.
They did. They felt it was strong, despite what he called normal seasonality.
Which for Q1 just means January started slow.
Yeah. Typically slower. But then activity built up through February and March. So that standard pattern held true this year too.
Okay. And buyer interest. Traffic.
They said traffic was solid. People were coming through the communities. That's positive, shows underlying interest.
That's a conversion was the tricky part.
That's the challenge, yeah. Converting that traffic into actual signed contracts. And that's where, affordability concerns, macro uncertainty.
Inflation, rates, jobs, all that stuff weighing on people.
Exactly. It really impacted the sales conversions.
So how are they tackling that affordability piece directly? Incentives?
Very actively using financing incentives, yeah. Trying to bridge that gap to a monthly payment people can handle.
Did they quantify it?
They did. Incentives were 4.7% of revenue in Q1, which is just like a tick up from 4.5% a year ago.
Okay, slight increase.
But looking at the more recent trend, trailing 13 weeks, incentives averaged over 7%.
Wow, okay, so more pressure recently.
It seems like it.
Right.
And they rolled out a specific tool in late March, too, a $10 million forward commitment program.
Offering what, like a specific rate?
Exactly. A locked-in rate of 4.99% in certain communities. Essentially, they pre-buy mortgage capacity to offer that rate. It's a powerful lever against volatility for the buyer.
Makes sense. Okay, let's talk land strategy. That's always key for them. Still land light.
Very much so. Still focused heavily on controlling land through option agreements. Keeps owned land low on the balance sheet.
How low are we talking?
At quarter end, less than 5% of their unstarted controlled lots were actually owned outright.
So that gives them flexibility, right, if markets turn sour.
Huge flexibility. They can walk away, limits that downside risk if demand softens, which is critical right now.
And what about land costs? Still going up?
Well, land inflation was a constant theme for the past year. But management said they're starting to see cracks, was the word they used.
Cracks, meaning maybe a shift?
Yeah, a potential shift towards more of a buyer's market for land in some areas. If that continues, their option strategy could give them, quicker negotiating power on new deals compared to builders locked in the land they bought high.
Interesting. Okay, operations, build times, cycle times. That's a big focus for efficiency.
That's absolutely. And they reported an average of 56 days across the company. That includes Houston.
Houston's the big integration story, right? Post-acquisition.
It is. They've made substantial progress getting Houston onto their RT platform. That's their internal system.
And the goal there?
They're targeting a 70-day build schedule just for Houston by the end of this year, which is like massive improvement.
From what? What was it before?
Nearly 200 days right after the acquisition. So yeah, huge difference.
And faster builds. That boosts returns, cuts cancellation risk.
Definitely. Speeds up return on capital, and buyers waiting less time are less likely to walk away. Crucial stuff.
What about spec inventory versus pre-sales? What's their approach there?
Their core preference is clear: pre-selling homes. Management thinks the business just runs better, more profitably that way.
Why is that? More customization.
Exactly. Pre-sold buyers make design choices. That opens the door for, high margin upgrades, lot premiums, plus someone who's personalized their home, less likely to cancel.
Makes sense. But did they have specs?
They did note they started the year with more standing specs than last year, and they actually said this inventory helped drive those Q1 conversions.
So the specs helped move metal in Q1. Are they still building specs now?
Well, they said they're continuing to start new homes, and interestingly, pre-sales have actually outpaced orders in the last couple of weeks. So it suggests buyers are still willing to commit early, which kind of validates that pre-sale focus.
Okay, let's pivot to the balance sheet then. How are they looking financially? Cash? Debt?
Ended Q1 with $12.7 million in cash. They had $40 million drawn on their unsecured revolver.
It's still plenty available.
Oh yeah, still had $195 million available to draw on that facility.
And the leverage ratios?
Pretty conservative. Debt to book capitalization was only 9.5%. Net debt to net book cap even lower, 6.9%.
Solid footing there.
And adding to that, they're finalizing an amendment to that credit facility.
Right. What's changing?
Increasing the total size by $75 million up to $325 million. And extending the maturity out by 4 years just adds more financial flexibility.
Good move. Okay, backlog. Homes under contract but not closed. What's that look like?
Ended Q1 with 791 homes in backlog. Average price about $341K, and they expect roughly 21.5% gross margin on those.
But that 791 number, how does that compare?
It's lower year over year. They had 1,100 homes in backlog, same time last year. Management acknowledged it reflects, a tougher selling environment overall.
Right. And within the quarter itself, how did the sales pace trend?
It was interesting. Started slower, 2.4 sales per community in January, then improved to 3.3 in February and hit 3.8 in March.
That's a decent spring pickup.
Yeah, but then they noted dip back down to approximately 3 sales per community in April.
Okay. So maybe some of that spring momentum softened a touch heading into Q2.
Potentially, yeah. Something to watch.
And community count. Are they growing the number of places they sell from?
Ended Q1 with 87 active communities. They are planning for modest community count growth through the year, working on opening new sites.
Got it. So let's tie some things together for investors. That gross margin, 23.8%. You said it was lower than last year's 26.1%. Why the drop?
Primarily 2 things, according to them. First, higher average lot costs. Tick up to 25.5% of revenue from 23% a year ago.
Okay. Land's getting pricier.
And second, those rising incentives we talked about earlier.
Right.
Using those to drive sales eats into the margin.
Makes sense. What about SG&A? Selling general administrative costs.
Also saw a slight increase as a percentage of revenue, 14.7% versus 14.5% last year.
Is that just general bloat or?
Management clarified it wasn't like runaway overhead, mostly driven by increases in payroll and performance-based compensation. They feel they're managing costs tightly while still supporting growth.
Okay. Now let's circle back to those income adjustments you mentioned, the reported versus adjusted net income. What was going on there?
Right. So the reported numbers included some specific charges. They exited a community in Houston, which resulted in a $642,000 impairment in cost of sales, and also a $716,000 lot option abandonment charge under other income expenses.
So specific one-off type things.
Exactly. And it highlights their structure, their UPC and UPC structure.
Yeah.
So the reported net income only reflects the public shareholders' slice of the pie, which is about 17.5% economic ownership.
And their tax rate is different too.
Yeah, a very low effective tax rate on that slice, 4.4% reported. The adjusted net income figure assumes 100% public ownership and applies a more typical blended tax rate, like 24.9%.
Okay, so that adjusted number is the better one for comparing them to, say, Lennar or D.R. Horton.
Generally, yes. It gives you that cleaner apples-to-apples view versus standard C-Corp.
Got it. Okay, outlook. What did they say about the rest of this year? Did they give full-year guidance?
They didn't. No formal full-year guidance.
Yeah.
Explicitly cited the macro uncertainty. Just too much unpredictability out there right now.
But they must have some kind of internal target.
They do. They reiterated their target is still 3,000 to 3,100 closings for the full year, if the macro environment cooperates.
Big if.
Huge if.
Mm-hmm.
They said they have the communities, they have the lots controlled to hit that number, but actually hitting it heavily depends on affordability, the rest of the selling season, and just the broader economy, inflation, jobs, rates, confidence.
The usual suspects.
The usual suspects, exactly.
Did they comment on competitors? What are other builders doing?
Yeah, they mentioned they're hearing discussions, seeing some signs that other builders might be slowing down their housing start.
Why? Too much inventory.
Likely, yeah. Probably accumulated too much standing spec inventory that's just harder to move in this market.
But Smith Douglas isn't doing that.
Their strategy was different. They deliberately pushed starts late last year, end of 2024. The idea was to keep their machine running, make sure they had homes available, and they said that actually helped drive those Q1 conversions.
So having available homes paid off.
Seems like it did for Q1. And they plan to continue pushing starts, feeling confident in their presale focus, balancing things out.
Okay. Quick update on their mortgage JV Ridgeland. How's that performing?
Capture rate, the percentage of their buyers using their financing was 56% last week.
That sounds okay. What's the goal?
Goal is much higher, over 90%.
Big gap.
It is. But the good news is they just got fully licensed in all their markets now, including Atlanta.
Which is their biggest market rate.
Biggest market. So getting licensed there should really help improve that capture rate going forward. And the JV has been helpful for implementing things like those forward commitment programs consistently.
Gotcha. One last thing. Did they mention that Lance home deal? The Apollo investment?
They touched on it briefly, yeah. Saw it mainly as a positive sign for home building overall. Shows strong backers still see opportunity in the space.
But no direct impact on them.
No, they noted Lance Home doesn't really operate in their specific markets. So, interesting development, but not a direct competitive thing for them right now.
Okay, makes sense. All right, let's shift gears. Time for our completely speculative, this is not financial advice's segment.
Love this part.
Just thought experiments, right?
Okay.
Based on the call. Maybe how you'd hear it pitch in some, hedge fund meeting.
Exactly. Just spitballing here. Idea number one, playing that spec inventory theme we just talked about.
Okay.
Consider a, let's say, aggressive pair trade. You short a public builder, one known to be sitting on a lot standing spec inventory, you know the names, while simultaneously going long Smith Douglas homes.
Okay, what's the thesis?
The thesis is SDH's land-light model, their focus on pre-sales, those improving cycle times. It gives them a strategic edge to navigate a slowdown, maybe even a correction, much more cleanly than competitors burdened by costly aging specs.
And the outrageous part.
The outrageous part could be, well, picking a really big, well-known competitor for that short side, or just the sheer amount of leverage you might hypothetically apply to make the bet meaningful.
Got it. Okay, pitch number two.
Pitch two, pure macro bet, tied to their incentives. This is a low probability, high impact kind of idea.
Okay, I'm listening.
You structure a highly levered play that only pays off massively if mortgage rates do something totally unexpected and drop, like plummet rapidly against all consensus.
Triggered by what, some crazy economic event, Fed panic?
Something like that, yeah. A real black swan event for rates.
Yeah.
If that happened, affordability instantly improves, right? Demand surging.
And builders pull back incentives.
Exactly. Builders like Smith Douglas could yank those costly financing incentives, that 4.99% forward commitment, maybe others way faster than anyone expects. That could cause margins to just explode upwards. Profitability spikes. Market is definitely not pricing that in today.
And the outrageous part there is just betting heavily on that wild, unlikely rate move itself.
Precisely. The timing, the magnitude, highly speculative.
Okay. And again, just to hammer it home.
Crystal clear. This is purely illustrative. Discussion fodder based on the call's themes, not actual investment recommendations.
Understood. Okay, so wrapping this deep dive up, what's the big picture from the call?
Seems like Smith Douglas had solid execution in Q1. They navigated okay despite those macro headwinds hitting conversions.
And their core strategy is holding. Land light, pre-sales, cycle times, incentives.
That's still the playbook, yeah.
Yeah.
But those challenges, affordability, market uncertainty, they're significant. And it's clearly why they're holding back on full year guidance, even while keeping that aspirational target out there.
Remember, folks, this whole conversation, based purely on the info from their earnings call, should not be taken as financial advice.
Absolutely not.
But as you think about the home building sector now, consider that strategic split, right? You've got Builders like Smith Douglas, Landlight, presale focus. Then you've got others maybe heavier on owned land, lots of spec inventory.
That's a fundamental difference.
So the question to ponder is, if this challenging market continues or even gets tougher, which of those strategies do you think is better positioned? That's something worth thinking about.